The gold standard shakeup. An in-depth analysis of the post-Warsh nomination market correction and the future of precious metals. The global financial markets are currently navigating one of the most turbulent periods in recent history. Following a historic run-up in precious metal prices, the markets witnessed a catastrophic wipeout late last week, characterized by a massive liquidation of long positions in gold and silver. This correction was triggered primarily by a singular, high-impact political event: US President Donald Trump's nomination of Kevin Warsh as the next chairman of the Federal Reserve. This report analyzes the stabilization of gold prices in early Asian trade on Monday, the mechanics behind the 10% crash, the implications of a Warsh-led Federal Reserve, and the future trajectory of the precious metals complex as we move toward the end of the decade. The Monday morning stabilization, 1.1, the calm after the storm. As the sun rose over Asian financial hubs on Monday, a sense of tentative calm returned to the trading floors. After a week of absolute carnage that saw billions of dollars in value erased from the precious metals sector, gold prices finally found a footing. The panic selling that defined the previous Friday, a day now being referred to by traders as the golden capitulation, appeared to have exhausted itself. In early Asian trade, spot gold managed to claw back some territory, rising 0.2% to trade at 4,170.68 tons per ounce by 1923 ET. While this gain is modest compared to the losses sustained previously, it represents a critical psychological victory for bulls who were fearing a breakdown below the $4,800 support level. 1.2. The futures market disconnect. Interestingly, the futures market showed significantly more aggression than the spot market. Gold futures contracts for April delivery surged, jumping nearly 3% to $4,186.31 per ounce. This divergence between spot and futures prices suggests that while immediate physical demand remains cautious, speculative interest is already betting on a rebound. Traders are looking past the immediate shock of the news cycle and positioning themselves for the next leg of the commodity supercycle. 1.3. The context of the price levels. It is crucial to pause and appreciate the absolute price levels we are discussing. With gold hovering near $4,900, the global economy is clearly in a very different state than it was in the early 2020s. These prices reflect years of accumulated inflation, currency debasement, and a fundamental shift in how the world views store of value assets. However, even in a bull market of this magnitude, gravity still applies. The stabilization on Monday serves as a reminder that no asset goes up in a straight line forever. Anatomy of the crash. 2.1. The 10% wipeout. To understand Monday's stabilization, one must dissect the violence of last week's move. Spot gold wiped out nearly 10% of its value in a single trading session on Friday. For an asset as liquid and established as gold, a 10% daily move is statistically incredibly rare. A Six Sigma event that usually signals a fundamental regime change or a massive liquidity crisis. Just days prior to the crash, gold had hit a fresh all-time record high of nearly $5,600 per ounce. The fall from $5,600 to below $4,900 represents a destruction of wealth that caught retail investors, institutional funds, and central banks off guard. 2.2. The drivers of volatility. The crash was not caused by a single factor, but rather a perfect storm of three converging forces. Extreme profit-taking. After a relentless rally that saw gold gain month after month, traders were sitting on massive unrealized gains. The moment the tide turned, the rush to lock in profits created a cascading sell-off. Monetary policy. Uncertainty. The looming end of Jerome Powell's term created a vacuum of leadership. Markets hate uncertainty more than they hate bad news. The dollar recovery. The US dollar, which had been languishing at a 4-year low, suddenly found a bid. Since gold is priced in dollars, a rising dollar acts as a mathematical anchor on gold prices. The Kevin Warsh factor 3.1. The nomination event. The primary catalyst for the market reversal was political. US President Donald Trump officially nominated Kevin Warsh to serve as the next chairman of the Federal Reserve, replacing Jerome Powell when his term expires in May. This announcement sent shockwaves through Wall Street. While Kevin Warsh is a known quantity, having formerly served as a Fed governor, his economic philosophy stands in stark contrast to the prevailing consensus of the last decade. 3.2. Clearing the uncertainty. The first reaction of the market was one of relief, albeit a paradoxical one. The nomination cleared out a major point of uncertainty. For months, speculation had run rampant about who Trump would pick. Would it be a loyalist, a chaotic outsider, an academic? By picking Warsh, a credible institutional figure with a track record, the immediate fear premium was removed from the market. Gold thrives on fear and uncertainty, safe haven demand. When uncertainty is removed, the safe haven premium evaporates. 3.3. The hawk in the high tower. However, the relief quickly turned to anxiety regarding policy. Kevin Warsh is widely perceived as a hawk, an economist who prioritizes fighting inflation over stimulating growth. The inflation fighter. ANZ analysts noted in their report to clients, Warsh is considered the toughest on inflation among the candidates for the role. The consequence: if Warsh is tough on inflation, he is less likely to support dramatic easing of monetary policy, i.e., lowering interest rates or printing money. Gold, being a non-yielding asset, it pays no dividends or interest, struggles when interest rates are high. If the market believes Warsh will keep rates higher for longer to crush inflation, the investment case for gold weakens in the short term. 3.4. The asset buying conflict. Perhaps the most significant aspect of Warsh's ideology is his stance on the Fed's balance sheet. Warsh has historically balked at the Fed's asset buying operations, QE. Explained. QE involves the Fed buying bonds to inject cash into the system. This devalues the dollar and boosts hard assets like gold. Warsh's view. Warsh views QE as a distortion of free markets. The market reaction. If Warsh stops QE or initiates aggressive quantitative tightening, QT, the liquidity that fuels asset bubbles dries up. This realization triggered the wave of selling. Investors realized that the easy money era might officially be ending under Warsh. 3.5. The Trump-Warsh paradox. There is a fascinating tension in this nomination. President Trump has frequently called for sharply lower interest rates. Warsh has aligned with these calls verbally. However, Warsh's fundamental philosophy is hawkish. The question: will Warsh lower rates because Trump wants him to, or will he hold firm on his anti-inflationary principles? The market bet. The market is currently betting that Warsh's hawkish nature will prevail over political pressure, at least initially. This reduces the likelihood of the currency debasement that gold bugs were betting on. The role of derivatives and options, factor 4.1. The gamma squeeze. Unwinding. One of the most sophisticated reasons for the crash lies in the options market. The ANZ analysts highlighted that the declines were exacerbated by some extreme positioning in options markets. 4.2. how positioning built up. During gold's massive run through late 2025 and early 2026, speculators piled into call options, bets that the price would go up. As the price rose, market makers, the banks selling these options, were forced to buy more and more physical gold to hedge their exposure. 4.3. The chain reaction. When the Warsh news hit and prices dipped slightly, the reverse happened. Market makers no longer needed to hold as much gold to hedge. They began selling. This triggered stop-loss orders from retail traders. As the price fell, more options went out of the money. This forced more selling by algorithms. The result was a cascade, a liquidity event where selling begat more selling. This explains why the drop was so sharp, 10%, and why it happened so quickly. It was not just fundamental selling, it was a mechanical unwind of leverage. The broader precious metals complex. 5.1. Silver's massive volatility. While gold grabbed the headlines, silver experienced even more dramatic volatility. Silver is often called gold on steroids because it is a smaller market and reacts more violently to the same news. Following the crash, spot silver staged an impressive recovery on Monday, jumping nearly 4% to $87,795 per ounce. The industrial angle. Unlike gold, which is purely monetary, silver is an industrial metal used in solar panels, electronics, batteries. The rebound in silver suggests that while the monetary premium took a hit from Warsh AS nomination, the industrial demand remains robust. The price level. At nearly $88 per ounce, silver is trading at levels that were unimaginable a few years ago, confirming a secular shortage of the white metal. 5.2 Platinum steadies. Spot platinum also found a floor, steadying at $2,159.79 per ounce. Platinum has lagged behind gold and silver in this cycle, but is now catching up due to supply constraints in major producing nations. Its stabilization around $2,160 indicates strong support from the automotive and green hydrogen sectors. 5.3. The ratio analysis traders often look at the gold-silver ratio. With gold at $4,170 and silver at $87.70, the ratio sits around 55.1. Historically, this suggests silver still has room to outperform gold if the bull market resumes. The dollar dynamic. 6.1. The inverse correlation. The relationship between the US dollar and gold is the most important correlation in global finance. Usually, they move in opposite directions. Weak dollar. Strong gold. Gold is cheaper for foreign buyers. Strong dollar. Weak gold. 6.2. The 4-year low. Before the Warsh nomination, the dollar had hit a 4-year low. 6.3. The rebound Warsh's nomination changed the calculus. If Warsh is a hawk, US interest rates might stay higher than European or Asian rates. Capital flows to where it is treated best, high yields. Therefore, capital started flowing back into the dollar. The dollar rebounded sharply, exerting pressure on metal markets. As the dollar index, DXY, climbed, algorithmic trading bots automatically sold gold contracts, deepening the rout. Geopolitics and the January effect. 7.1 Monthly performance context. Despite the catastrophic end to the week, the article notes a crucial statistic. Gold still ended January up nearly 15%. This is a staggering monthly return. It highlights that the Warsh crash was merely a dent in a massive uptrend. 7.2 Geopolitical uncertainty. Why was gold up 15% in January? The text cites heightened geopolitical uncertainty. In the context of this 2025-2026 timeline, this likely refers to escalating trade wars, regional conflicts disrupting supply chains, loss of trust in sovereign debt. When nations do not trust each other, they settle trade in gold, not dollars or euros. This central bank buying provides a floor for gold prices. Even if Kevin Warsh wants to strengthen the dollar, he cannot control geopolitical strife. As long as the world is unstable, the haven demand for gold will persist. Outlook and conclusion. 8.1. The battle ahead. The market is now entering a phase of discovery. The battle lines are drawn between the bears, who believe Kevin Warsh will crush inflation, strengthen the dollar, and end the gold party. The bulls, who believe the US debt situation is so severe that no Fed chair, not even Warsh, can stop the printing press eventually. They view the drop to $4,170 as a generational buying opportunity. 8.2 Technical levels to watch. Support, $4,800 is the line in the sand. If this breaks, gold could slide further. Resistance, $5,000 is the psychological barrier. Bulls need to recapture this level to prove the Monday recovery is real. Record high. $5,600 remains the ultimate target. 8.3 Final verdict. The nomination of Kevin Warsh has undoubtedly reset the board. It has introduced a new variable, a hawkish Fed, into a market that was complacent about easy money. The wipeout was a necessary cleansing of speculative foam. However, the fundamental drivers of gold, geopolitical chaos, industrial demand for silver, and the long-term trend of currency devaluation remain intact. Monday's stabilization is the first step in the market digesting the new reality. Whether this is a dead cat bounce or the start of a rally to $6,000 depends entirely on how Kevin Warsh navigates his first few months as the most powerful banker in the world. For now, the gold market holds its breath, battered but not broken, waiting for the next move from Washington.